Sanjeev Prasad, Senior Executive Director and Co-Head with the Kotak Institutional Equities, who joins us from Singapore via the Skype link. Sanjeev, good morning. Thank you for joining us. Sanjeev, we've come a long way from the recent low. Indian markets clearly have rallied against fundamental odds. Do you think this is as good as it gets, or the force of liquidity could take us higher?
It's possible, although I really don't want to bet on liquidity as a theme for investment. Next 2-3 months look okay from India perspective, whether it is global factors or domestic factors. They look fairly supportive. So let's look at the global factors first. As of now, it looks like tapering is off the agenda for maybe 3 months, although some observers are still talking about December as a time frame when the Fed could actually start the tapering process, but maybe it's early part of next year when it actually happens. So that's some amount of relief from the external environment. If you look at the domestic factors, there is some stability as far as the rupee is concerned, so that's a positive. Earning numbers this quarter, so far so good, although there is some one-off items in some companies, but in general, earning numbers are slightly better than expectations and no major disappointments in this quarter so far. So that's again a positive take as far as domestic market is concerned. Inflation continues to be on the higher side, but hopefully with good monsoons and good output as far as kharif crop is concerned, hopefully that will start tapering down a little bit in the months of October, November. But that's as far as I think the good news is concerned. And maybe if you want to extrapolate into politics, you of course have 4 state elections coming up, and if you have an outcome which the market thinks as favorable, that is more in favor of BJP/NDA. I'm not making any call on which political party is right or wrong, but as far as the market is concerned, but somewhere there is this perception that the BJP/NDA may be more positive for the market. So if there is something like 3-1, 4-0 score in favor of the BJP in those 4 states, then I think the market will take that positively. But if it is say 2-2, then obviously it's going to be some amount of confusion whether that's a prelude to the national elections in April, May, and if there is a fair amount of uncertainty brewing on that front. So I think it looks okay for the time being, but do keep in mind the fact that valuations have become fairly stretched now, particularly of all the good quality large cap names. Just to recap, the overall market is trading at about 15.6 times on fiscal 2014 BSE 30 free float basis. That is pretty much on the higher side. Look at the range of valuations over a period of time. Even in 2015, it's about 13.6 for the BSE 30 index on a free float basis. So it doesn't look too bad, but when you start looking at the segregated valuations across sectors, you would notice that most of the good quality large cap names are becoming fairly expensive now, whether it is the consumer names, tier 1 IT names, good quality automobile stocks, pharma, etc. They're all trading at pretty high valuation. So I don't know, what sector will now drive the market. We'll have to, I guess, wait and see.
Yeah.
Sanjeev, what did you make of the IT move yesterday? And does it seem like, irrespective of positive earnings, it's all in the price now, valuations are looking rich, and what we saw yesterday could be a long-drawn period of corrective phase with the IT sector?
Obviously the stocks have done very well over the last 12 months. HCL Tech is up 100% in the last 12 months. TCS is about 70% up. So, obviously at some point in time you will start seeing some amount of profit booking coming in. More given the fact that valuations are on the expensive side. If you look at TCS, for example, it's trading at 21 times in March 2015 earnings, and it's a fantastically well-managed company, has been delivering very strong numbers quarter after quarter. But just given the size of this company and the valuation it's trading at, now the chances of disappointment are probably increasing. So I think people are just being a bit careful of the valuations over here. If you look at the other names in the tier 1 pack, whether it's HCL Tech or Infosys or Wipro, they've all traded up to somewhere about 14 to 15 times now on 2015 basis. So again, not very expensive, but probably getting to the upper end of the valuations. And I think given the fact that the rupee seems to be stabilizing, you're not seeing any more depreciation over there. In fact, you've seen a fair bit of appreciation in the last 1 month. So obviously, there's some nervousness building in as to, what does that mean for earnings. That will probably be good numbers, but I think it is all getting priced in at these levels, and probably that's where you're seeing some amount of profit booking coming in.
Do you think L&T could surprise everyone today, or they could disappoint with the change in the guidance?
It's a tough one. I think on the revenue side, they may be okay, but the big problem is on the margin side, because the revenue mix of the company is changing to more overseas business, where the margins are substantially lower. If you see the numbers for the first quarter, there was 60 bips decline as far as the EBITDA margin is concerned on a YOY basis, and I suspect that trend may continue. So I think the bigger issue here would be how do margins pan out rather than revenue itself, because as of now they do seem to have some amount of order book going for it. The other important thing to focus on would be the order book going forward, in terms of what new orders this company is in a position to book. So that's the more important number which I would focus on. That is what's happening to the margins. And the second is what's the order booking pipeline looking like.
Sanjeev, you track Reliance pretty closely. What did you make of the earnings this time around?
They seem to be quite good, slightly ahead of our expectations as far as net income level is concerned. 54.9, we had 54.2 billion rupees, so that's about 1% higher, so no complaints over there. As far as the EBITDA level is concerned, it came out around 5% higher. That was the expectation, mostly driven by higher profitability in the petrochemical segment, so that was a little bit of a positive surprise. But again, the good news is that petrochemical margins have been holding up very nicely. In fact, they continue to improve and at reasonably high levels currently. And obviously, the earnings got a boost from rupee depreciation both on a quarter-on-quarter and YOY basis. So I think this is one large cap stock where valuations are reasonable, and in the absence of any other great ideas in the large cap space where you're looking at valuation being reasonable, you could see some amount of money being parked in Reliance for the time being, till the time you get more clarity on the macro environment as also on the domestic factors.
Sanjeev, let's be slightly more descriptive about IT. That is the performing group. That group has delivered. Companies are growing in the range of about 10 to 15%, and P multiples are not that stretched. So despite the recent run-up, do you think Indian IT stocks have a long way to go?
In the medium term, no question about it. The only real issue would be in the, let's say, the next 12 months, whether the volume numbers will continue to be as strong as what you have seen for the last, I would say, 3-4 quarters. Do keep in mind the second half is typically not that good in terms of volume numbers. There is some amount of slowdown in the business in the US and Europe, more driven by the fact that the companies will start finalizing their IT budgets for the subsequent years. So typically the December quarter and the March quarter, which effectively become the second half for Indian companies, they are never that strong as compared to the first quarter. So there could be some disappointment on a QOQ basis over there, but I think YOY we should still be okay. The other challenge would be in terms of what's happening to the immigration bill, and you would have read the statement of President Obama a couple of days back when he mentioned that this thing is going to get back in the agenda pretty soon. So what contours and what shape the immigration bill eventually take place, and whether some of the earlier points which would have a negative for the IT sector in India in general, if those things are implemented, then I think there could be a little bit of a negative surprise for the stocks, given the fact that at this point in time none of those risks are getting factored in the valuations. As I was talking about earlier, valuation is no longer cheap, at about 14-15 times for most of the lot, which is HCL Tech, Infosys and Wipro. I think they are to some extent, if not fully discounting 2015 numbers, maybe about 85-90% already discounting those numbers, and TCS is a separate league altogether, trading at much higher multiples. So I think the scope for disappointment is there. Although having said that, it's not that high as of now. The business continues to be pretty strong. So the surprise, if any, could become from non-business factors. That is some sort of immigration bill which is pretty negative for the sector in general. And who knows? I mean, that's not too far away. It could be 3-6 months. You could start seeing some negatives emerging from there.
Broadly, what is your take now on consumer names? Consumer names are expensive, but of late, mid-cap consumer names have stabilized. Are you a buyer there?
Not at all. In fact, we have been quite negative on consumer names for some time. They have been pretty big underperformers actually in the last 3-6 months. Barring the pop which you saw in some of the names based on the open offers over there, Hindustan Lever and for GSK. Other than that, after that, most of the stocks have been pretty big underperformers. And even after that, the stocks are still very expensive. For the 17 consumer stocks which we cover, on an average, the PE is something like 29 times on 2015 basis. So, that is pretty expensive, I think, especially in the context of the fact that volume growth is decelerating across the board. And you saw the numbers of Bajaj Corp, and none of the companies are talking about any great volume acceleration going forward. So in that context, to argue for near 30 multiple for many of these names is, I think, being too optimistic. So I suspect you could continue to see some of the derating in these stocks, either through a time correction, or you could actually see the stocks come off to more reasonable levels.